When you sit down to play a game of chess, there is this incredible feeling when you spot an opening on the board. You see your opponent left their flank exposed or whatever, and you realize your knight is in the wrong position.
Right, so you make a move.
Exactly.
Yeah.
Swap your strategy, you reposition your pieces, and it just feels, it feels incredibly logical. It feels smart, right?
Yeah, because you're being proactive. You're responding directly to changing conditions.
And when it comes to investing, especially in tangible assets like precious metals,
Yeah.
it is dangerously easy to apply that exact same logic. Markets are always moving.
They are. The relative performance changes day by day.
Right. So if you're sitting on a pile of physical gold and you see that gold is peaking while silver is down and looking like a bargain, trading one for the other seems like the most logical, savvy investment move you could possibly make. You're repositioning yourself to capture the upside.
The intuitive appeal of that repositioning is exactly why the practice of swapping metals is so widespread. But we're looking at a guide today from First Gold Group that, well, it completely dismantles this assumption.
It really does. So welcome to today's deep dive. We are going to look under the hood to see how these swap transactions actually function. Because what is pitched to you as a strategic opportunity is it's really something else entirely.
Underneath, it's a mechanism that can fundamentally hollow out a portfolio.
Yeah, and we're going to unpack the hidden economics behind this practice, looking at the exact math provided by First Gold Group to see how the friction of these transactions actually works against you.
And to understand why this seemingly proactive strategy falls apart, we really have to define the terminology first.
Right, because the word swap itself implies a frictionless exchange. You hand over one thing, you get an equivalent value of another thing back, like trading a $20 bill for 2 10s at the bank.
Exactly. But in the physical precious metals market, a swap is never a one-to-one exchange. It is, well, it's two entirely distinct transactions engineered to look like one fluid motion.
2 separate transactions.
Yes. When a dealer advises you to execute a swap, you are placing a sell order to liquidate your existing holding, and you are immediately placing a separate buy order to acquire the new metal.
So this isn't like trading cash at the bank. I look at this like trading in a used car to buy another used car from the exact same dealership.
That is a perfect analogy, actually.
You don't just, hand over the keys to your Honda and drive away in a Toyota of the exact same Blue Book value. You roll onto the lot, you take a financial hit on the trade-in because the dealer has to...
They have to build in a profit margin for when they resell your old car.
Right. And then you turn around and pay a retail markup on the new vehicle you're buying. You get hit on both sides of the door.
You do. And the dealer's recommendation to execute this maneuver is frequently driven by the need to generate that very transaction activity.
Wait, really? Just to generate activity?
Yeah, because think about it. Physical precious metals are traditionally a buy-and-hold asset. For a dealership that relies on volume and transaction fees, a static portfolio doesn't generate ongoing revenue.
Oh, wow. I hadn't thought of it that way.
Initiating a swap creates a liquidity event. It triggers those two separate transactions, introducing entirely new costs for the investor while, generating fresh dealer revenue.
Let's look at the actual mechanism of those costs, because the retail markup in physical metals isn't quite the same as clicking a button in an online brokerage account, right?
Not at all. First Gold Group focuses heavily on a concept called the spread.
And for anyone used to trading paper assets where a spread might be, fractions of a penny, the physical market is a completely different landscape.
Totally different. The spread is the difference between a dealer's selling price, the ask, and their buyback price, the bid. In the physical metals market, this spread is significantly wider because it has to account for real-world friction.
Right, like physical logistics.
Exactly. When a dealer handles physical gold or silver, they are absorbing the costs of mint premiums, secure vault storage, heavy-duty insurance, armored transport.
All the real-world stuff.
Yeah, and the inherent volatility risk of holding physical inventory. To cover those overhead costs and maintain a profit margin, the dealer builds a substantial spread into the price.
So that spread is basically the toll you pay to enter a position and the toll you pay to exit.
Exactly. It's the cost of admission and the exit fee.
Which means during a swap, you are paying that physical toll twice in the span of a 5-minute phone call.
Yes, you are. And First Gold Group lays out the mathematics of this double transaction, and the compounding effect is, it's staggering.
Let's walk through their math. If we look at their first scenario, dealing with a 25% spread.
Okay, so let's say you make a $2,000 physical gold purchase. Because of that 25% spread, it immediately drops to a $1,500 liquidation value the moment you take ownership.
Wait, so you walk out the door, and the immediate cash value of your holding to that dealer is just $1,500.
Just 1,500. If you hold that gold for 10 years, the market price ideally appreciates and covers that spread. But if you execute a swap shortly after buying,
You voluntarily lock in that initial loss.
precisely, you take that $1,500 and immediately use it to purchase silver, which also carries a 25% spread.
Oh, man. So you buy $1,500 worth of silver at the dealer's ask price. And if you needed to liquidate that new silver position immediately at their bid price, what does First Gold Group's math say?
The liquid cash value drops to approximately $1,125.
Wow. $1,125. So the investor started with $2,000, attempted a strategic reallocation to optimize their portfolio, and effectively reduced their liquid wealth to $1,125.
Just through the sheer friction of the transactions.
That is brutal. Because needing to recover from 1125 back to 2000 means your new silver position has to appreciate by nearly 78% just for you to break even.
77.78% to be exact.
You need almost an 80% gain just to get back to the starting line.
Yeah.
That essentially turns a wealth preservation asset into a high-risk gamble.
It does. You're wiping out what could be a decade of average market gains just by reorganizing your safe haven assets.
And it gets worse, right? Because the guide pushes this even further with a 30% spread scenario.
Yeah, in that environment, an initial $1,000 investment gets hollowed out through a swap down to a $490 liquidation value.
Okay, wait, let's unpack this. I have to challenge that 30% figure. A 30% spread sounds extreme. Is First Gold Group cherry-picking a worst-case scenario just to make a rhetorical point? Or is that a reality in the retail market?
It's a stark reality in specific corners of the retail market, particularly when investors are steered toward heavily marketed premium coins or semi-numismatic items.
Oh, the collectible stuff.
Exactly. Dealers often attach massive premiums to these specific products, pushing the spread to 30% or sometimes even higher. When you swap in and out of those high premium products, the wealth destruction is severe.
I mean, by trying to be proactive and catch a market trend, I'm digging a hole so deep that, wait, recovering from $490 back up to your initial $1,000 requires roughly a 104% return.
Your investment literally has to more than double just to recover the money you walked in with.
That is just wow. That math really exposes the flaw in treating physical precious metals like a day trading account.
It really does.
It's the equivalent of running a marathon, where every time you change lanes, the officials move your starting block a mile backward. You aren't getting close to the finish line. You're actively ensuring you'll never cross it.
And the mathematical reality of swapping is that each transaction resets your starting point drastically lower. It locks in losses and creates a near impossible hurdle for profitability.
So the hurdle becomes mathematically insurmountable within any normal investment time frame. Every jump resets your baseline. Which raises the question, how are investors persuaded to make these moves when the underlying math is this punishing?
Well, the pitch on the other end of the phone is rarely framed around the spread. It's framed around market opportunity.
Ah, of course. The sales tactic probably relies on metrics like the gold-to-silver ratio. Like a broker calls and says, historically, silver is undervalued compared to gold right now. We need to move your assets to capture this historic divergence.
Exactly. It sounds sophisticated. It sounds like insider optimization.
So how does an investor spot the trap? With math that punishing, what are the warning signs?
The First Gold Group source outlines specific red flags to watch for. The most glaring indicator is a proactive solicitation to sell that is entirely disconnected from your personal financial goals.
Meaning, they call you out of the blue.
Yeah, if your time horizon, your retirement needs, and your risk tolerance haven't changed, but your broker is urgently suggesting a fundamental shift in your holdings, the motivation is likely transaction-driven, not strategy-driven.
I'd imagine another major trap is timing. If a broker calls me 3 weeks after I bought the gold, just because silver had a good Tuesday, The frequency of the trades has to be a massive warning sign.
Oh, absolutely. Frequent trading of physical assets is a massive red flag. The guide explicitly warns against recommendations based purely on short-term relative performance.
Like pointing to a weekly chart showing gold stalling and silver rising.
Right, that's a tactic used to create a false sense of urgency. It ignores the fundamental nature of the asset class.
It reminds me of going to a nursery and buying a small oak tree. You plant it in your backyard because your long-term goal is to have shade for your house in 20 years.
Okay, I like where this is going.
But then 3 weeks later, you notice the sun hits a different corner of the yard, a little better in the afternoons. So you dig the tree up and move it. A month later, you notice the soil retains water better near the fence, so you dig it up again.
The tree doesn't grow faster because you are optimizing its location.
Exactly. The tree dies. You aren't optimizing anything. You're destroying the root system through the sheer stress of constantly uprooting it.
That's a great way to look at it. Physical precious metals are designed to function as a store of value. They are an anchor for wealth preservation, not a vehicle for speculative agility.
Right.
The first gold group philosophy emphasizes that allowing time for market cycles to play out over years or decades is the only way this asset class functions properly. The friction of the spread is the stress on the root system.
Okay, but let's say I'm ignoring the salesperson. I'm looking at my own portfolio, and I independently decide my asset allocation is wrong. I genuinely believe I need to shift from silver to gold based on, I don't know, macroeconomic factors I've researched. Is it ever safe to switch metals? First Gold Group isn't saying you are permanently locked into your first purchase forever, right? There has to be a way to execute a reallocation without destroying half your wealth.
They acknowledge that strategy shifts happen, yes, but they outline strict rules of engagement for damage control. If you initiate a swap, you must aggressively negotiate the terms of both sides of the transaction.
Okay, so how do we do that?
First, you have to demand a buyback price on your existing metal that is as close to the current spot price, meaning the raw market index price, as possible.
So the takeaway isn't that you are permanently forbidden from changing your mind, but rather that you have to become an incredibly defensive negotiator on the spread if you do.
Yes. You have to fight to compress that first spread so you aren't taking a massive hit on the trade-in.
That makes sense.
And then you apply that same pressure to the new purchase. You cannot accept a standard 25% or 30% retail markup on the second leg of the swap. You have to demand a minimal premium and insist that all pricing is fully transparent before you authorize anything.
You mean the bid, the ask, the exact dollar amount of the spread on both sides?
Everything fully disclosed.
What if my original position is currently underwater? Say I bought gold at a peak, the market dipped, and now a broker is suggesting I swap into silver to write a sharper recovery curve and make my money back faster.
First Gold Group specifically addresses this scenario, and it's a crucial piece of advice. Realizing a loss on an existing position to fund a new position with a fresh spread is incredibly destructive.
Really? Even if silver is climbing faster?
Yes. If your holding hasn't reached profitability yet, maintaining the existing position and waiting for the broader market to recover is almost always mathematically superior to paying the transaction toll to start over from a deeper hole.
Wow. So you don't lock in a permanent loss just for the psychological comfort of feeling like you are taking action.
Exactly. It requires discipline. The first Gold Group approach fundamentally rejects swap-driven sales strategies because they rely on obfuscating these costs. A sound precious metal strategy is built on transparency, clear pricing, and disciplined long-term acquisition.
You add to your position over time rather than constantly churning your existing capital.
Precisely.
Looking at the entire scope of this guide, the core insight here is a profound shift in how we view action versus inaction in a physical portfolio. A precious metal swap will almost always be dressed up in the language of a strategic market opportunity.
Oh, absolutely. It's always pitched as the smart move.
But functionally, mechanically, it is a double transaction where the compounding weight of the spread heavily benefits the dealer and severely penalizes the investor.
It's all about who takes the risk and who takes the fee.
Right. Friction is the invisible tax on your proactive intentions. Protecting your wealth isn't just about picking the right metal at the right time. It's about understanding the toll booths on the road. You can make the absolute right call on the direction of the global silver market. But if you lose half of your capital to the spread just to position yourself, you still lose the game.
You do.
Yeah.
And it forces us to evaluate the structural differences between asset classes. We live in an era of Zero commission, frictionless trading in paper assets like ETFs and
Oh,
equities.
yeah, you can panic sell a stock from your phone while waiting in line for coffee.
Exactly. But the physical friction we've discussed today, the heavy spreads, the logistics, the transactional toll, it might actually be a hidden feature rather than a bug.
How so?
That friction acts as a structural barrier to emotional, short-term decision-making. If you know a swap requires a 78% return just to break even, you are forced to slow down, ignore the daily market noise, and commit to the long-term wealth preservation these metals were built for.
That is a fascinating way to look at it.
And I'll leave you with a final question to mull over. If short-term trading of physical assets relies on spreads that inherently benefit the middleman, how does that change the way you evaluate any piece of proactive financial advice?
Oh, that's good.
Ask yourself, is this recommendation designed to improve your long-term outcome, or is it simply designed to generate activity?